COVID-19 relative to our pre-pandemic expectations, we have made substantial progress and are far down that path. As we have throughout the pandemic, we continue to expand our competitive moat through leading strategic partnerships. First, we are excited to have agreed with our partners at CaixaBank to acquire Bankia's payments businesses in Spain. Specifically, we will enhance our position in one of the most attractive acquiring markets in Europe with the addition of Bankia's merchant business, consisting of roughly 100,000 customers in the region. This pending acquisition further enhances our distinctive distribution and will allow us to delight Bankia's customers with our market-leading technologies, providing us with significant cross-selling opportunities and deepening our presence with one of the leading institutions in Europe. This agreement follows our purchase of an additional 29% stake in our Comercia joint venture last October, which increased Global Payments ownership to 80%. Additionally, our MoneyToPay joint venture has agreed to purchase Bankia's prepaid business as we continue to execute on our strategy to expand and diversify our Netspend business into international markets. We expect both of these transactions to close in the fourth quarter. Second, we are delighted to announce that we have entered into a new collaboration with Amazon Web Services, AWS, for unique distribution and cutting-edge technologies at Netspend to substantially increase our target addressable markets and accelerate our strategy across our three pillars of digitization, internationalization, and B2B expansion. Much as we have done with our issuer business, we plan to leverage the AWS partner network and dedicated partner development specialists to bring Netspend's B2C and B2B digital payment solutions, including program management, to a broader base of neobanks, fintech startups, and other e-commerce players, as well as to new geographies. This partnership will also provide an industry-leading cloud-based processing platform for Netspend's customers to access cutting-edge technologies with greater speed to market, security, and flexibility. We are thrilled to deepen our go-to-market collaboration with one of the world's largest technology companies to continue our disruption of these markets. Third, we are pleased to have closed our acquisition of Zego in June, further capitalizing on the convergence of software and payments in one of the largest and most attractive vertical markets worldwide. As I highlighted last quarter, real estate is the quintessence of the type of market that we seek: sizable, global in scope, fragmented, and ripe for further software, digital commerce, and payments penetration. And COVID-19 has accelerated the underlying trends that make this $6.5 billion target addressable market so attractive as we continue to expand our software-driven footprint. It is my great pleasure to welcome Zego team members to Global Payments. In addition to these strategic accomplishments, we produced yet another outstanding quarter of results. Since we began running the company in 2013, our main focus has been on two areas: enabling diverse, distinctive, and defensible distribution, and developing market-leading technologies. We could not be more pleased with the momentum across our businesses, evident in our second quarter results and reflected in our increased guidance for 2021. It's worth noting that we have delivered the greatest value creation in our history over the last 8 years, despite numerous new market entrants during the entirety of that period, public and private. And we have generated consistent financial and operating outperformance through a variety of macroeconomic cycles, including most recently the financial impact of the first worldwide pandemic in over 100 years. The results are self-evident. We have record performance in the second quarter in our merchant segment on several bases: absolute, sequential, and year-over-year, while also producing strong growth versus pre-pandemic levels. Simply put, our payments businesses continue to significantly outperform and gain share, fueled by our long-held technology-enabled focus and solid ongoing execution. On a more granular basis, we saw strong double-digit growth in new sales in both Global Payments Integrated and our vertical market businesses in the quarter, and our U.S. relationship-led business again achieved record new sales. This marks the third quarter out of the last 4 in which we have achieved such a high level of performance. Rather than impede our strategy, the pandemic spurred further share gains and catalyzed the digital strategies we have had in place since 2013. Our omnichannel businesses accelerated yet again in the second quarter with growth in excess of 20%, despite lapping the enhanced shift toward e-commerce globally that began with the start of the pandemic in early 2020. New customer signings this quarter include Foot Locker as a key customer in Europe that will leverage our Unified Commerce Platform, or UCP, to modernize its payment acceptance capabilities. We are pleased to have also signed new global UCP partnerships with Hunter Douglas and Euronet worldwide subsidiary Z.com. Our ability to deliver a single API solution virtually around the world has been a key driver of our success. And our unique multinational footprint in both the virtual and the physical worlds has proven to be a differentiator versus both legacy and new market entrants. Within our vertical market businesses, we had a number of new key customer wins for our quick service restaurant business, including Frisch's Big Boy, Crystals, and the Fiesta Group, while AMD and TouchNet continue to deliver record revenue performance as they have throughout the pandemic. Notably, TouchNet continues to add new marquee colleges and universities domestically and internationally, including the Arkansas State University System and Sheridan College in Canada this quarter. We are also making great progress in our partnership with Google and remain on track to board Google as a merchant customer this quarter and expect to launch our Run and Grow My Business product that integrates Google solutions in our digital portal environment in the fourth quarter. Our issuer business delivered growth beyond the high end of our targeted long-term range. We are pleased to have signed a new multi-year partnership with Banco Carrefour in Brazil, the financial services arm of the country's leading supercenter retail chain, to provide a range of technologies for its credit card and digital accounts, as well as to handle on-us acquiring transactions. Recall that transaction optimization is one of our key post-merger initiatives. More to come on that at our investor conference. We also signed a letter of intent with a large global financial institution and longstanding partner in a new market in LATAM that will mark another significant milestone for us in our continued expansion into the region. Further, we executed a multi-year extension with the UK's largest retailer, Tesco, enabled by our shared digital modernization vision for the future. Finally, we are pleased to have extended our relationship with Mercury Financial for a range of digital technologies. This relationship serves as further proof that our industry-leading platform offers the agility to support leading-edge fintech companies. TSYS recently launched a strategic go-to-market partnership with PricewaterhouseCoopers, or PwC. As part of the TSYS Partner Program, we expect that our collaboration with PwC will diversify and expand our distribution and allow us to jointly offer innovative solutions, expertise, and execution capabilities to clients of all sizes across the full spectrum of neobanks, fintech, startups, and program managers. Again, diversification of distribution has been one of our key objectives since 2013, and we are using the same playbook with TSYS that we have successfully deployed in the past. We continue to capitalize on the broad and deep pipeline we have the good fortune to have in our issuer business. Today, we have 15 letters of intent with institutions worldwide, 6 of which are competitive takeaways. Turning to our unique collaboration, we now have 20 active prospects in our pipeline with AWS, up from a dozen last quarter and 4 at the end of 2020. These include a mix of new financial technology entrants and other non-traditional issuers, in addition to large financial institutions. As growth accelerates in this market, we believe that we are the ones doing the disrupting. While buy now, pay later solutions may seem novel to some, we have in fact been providing leading technologies to that segment of the market for decades in both our issuer and merchant segments. And we continue to deliver innovative installment payments products for customers. We are currently enabling our merchant customers in Canada in partnership with Desjardins with the Visa installment solution. CIBC will also launch a combined TSYS Visa installment solution in early 2022. and we signed a global referral agreement with MasterCard, supporting installment payments in June. Finally, in our business and consumer segment, we expect a unique co-sale arrangement with AWS to expand our distribution capabilities, again, much like we've been doing since 2013. And together with our issuer business, we intend to further disrupt the program management segment in the near future. This is yet another example of application of our strategies to legacy TSYS businesses, and we expect the same successes here as we have generated in other contexts. Paul?
Thanks, Jeff. Our financial performance in the second quarter of 2021 demonstrated meaningful sequential momentum and exceeded our expectations. These results highlight outstanding execution on our differentiated strategy of technology enablement. Specifically, we delivered adjusted net revenue of $1.94 billion, representing 28% growth compared to the prior year and 10% growth compared to 2019. Adjusted operating margin for the second quarter was 41.8%, a 480 basis point improvement from the prior year, despite the return of certain costs we temporarily reduced at the onset of the pandemic. The net result was adjusted earnings per share of $2.04 for the quarter, an increase of 56% compared to the prior year, and a 35% improvement from the same period in 2019. Taking a closer look at our performance by segment, Merchant Solutions achieved adjusted net revenue of $1.29 billion for the second quarter, a 42% improvement from the prior year. We delivered an adjusted operating margin of 48.5% in this segment, an increase of 750 basis points from the same period in 2020, as we continue to benefit from the recovery and our improving technology-enabled business mix. We are pleased that our acquiring businesses globally generated 46% adjusted net revenue growth compared to the second quarter of 2020, led by strength in the U.S. Notably, our U.S. acquiring business, which includes our integrated and relationship-led channels, grew approximately 25% compared to the same period in 2019. These results were led by our integrated business, which produced a stellar quarter, generating a 53% adjusted net revenue improvement compared to 2020 and 35% growth relative to 2019. As for our own software businesses in the U.S., we are delighted with the overall portfolio delivered growth of roughly 30% compared to the prior year and achieved solid sequential improvement relative to the first quarter. As Jeff mentioned, our vertical markets businesses continue to see positive bookings trends, providing us with a favorable tailwind for the second half of 2021. Additionally, our worldwide e-commerce and omni-channel businesses saw growth in excess of 20% year-on-year, as our value proposition, including our Unified Commerce Platform, or UCP, continues to resonate with customers. Regarding our international businesses, while these markets have been a bit slower to recover compared to the U.S. on an absolute basis, our portfolio of businesses across Europe and Asia contribute favorably to our overall merchant adjusted net revenue as a growth matter compared to 2020. These businesses also returned to growth on a combined basis when compared to 2019. Moving to Issuer Solutions, we are pleased to have delivered a record $446 million in adjusted net revenue for the second quarter, marking an 8% improvement from the prior year period. This strong performance was driven by the ongoing recovery in transaction volumes across many of our markets, while non-volume-based revenue increased mid-single digits during the period, led by our output service business, which grew at roughly 10% for the quarter. Our issuer business also achieved record second quarter adjusted operating income, and adjusted segment operating margin expanded 110 basis points from the prior year, also reaching a new second quarter record of 43.9%, as we continue to benefit from our efforts to drive efficiencies in this business. This is an impressive result, particularly given we achieved margin expansion of 640 basis points in the second quarter of 2020. Additionally, our issuer team signed 5 long-term contract extensions during the quarter, and our strong pipeline bodes well for future continued momentum going forward. Finally, Our Business and Consumer Solutions segment delivered adjusted net revenue of $227 million, representing growth of 5%, despite lapping the benefit of the 2020 CARES Act last year. As a reminder, this business delivered double-digit growth in the second quarter of 2020, driven in part by our support of the disbursement of over $1.4 billion in stimulus funds during that period. Adjusted operating margin for this segment was 26.9%, which was also ahead of our expectations. The outstanding performance we delivered across our businesses serves as a further proof point that we continue to gain share, as well as the alignment of our strategy with the accelerating digital trends coming out of the pandemic. We are also pleased that our integration continues to progress well, and we have now executed actions allowing for the achievement of annual run rate expense synergies of at least $400 million and annual run rate revenue synergies of at least $150 million that we have been targeting exactly as we said we would do, and despite the pandemic. We will continue to deliver additional expense and revenue synergies over the coming periods as our efficiency efforts continue and we leverage the collaborative growth opportunities across our businesses. From a cash flow standpoint, we generated second quarter adjusted free cash flow of roughly $452 million, or a little over $1 billion through the first 6 months, and continue to expect adjusted free cash flow in excess of $2 billion for the year. We reinvested approximately $130 million in capital expenditures during the quarter and continue to expect capital expenditures in the $500 to $600 million range for the full year. In June, we successfully closed our acquisition of Zego, consistent with our expectations, and we expect this business will contribute roughly $50 million of adjusted net revenue to our merchant segment in 2021. I would like to echo Jeff's excitement regarding the agreements we announced today to acquire Bankia's payments businesses in Spain, and we expect these transactions to close in the fourth quarter. Further, we remain on track to complete our purchase of Worldline's Pay1 business in Austria in the second half of this year. We are pleased to have continued to return cash to our shareholders this quarter with the repurchase of 1.5 million of our shares for approximately $290 million. Following our balanced deployment of capital this quarter, we ended the period with roughly $3.3 billion of liquidity and a leverage position of roughly 2.6 times on a net debt basis, which is flat to last quarter as expected, and this leaves us with continuing ample capacity going forward. Based on our current expectations for the continued global recovery, we are again increasing our guidance for adjusted net revenue to now be in a range of $7.7 billion to $7.73 billion, reflecting growth of 14 to 15% over 2020. We continue to expect adjusted operating margin expansion of up to 250 basis points compared to 2020 levels on a standalone basis. As a reminder, Zego will be a modest headwind to the upper bound of our margin target now that it is closed, as it does not currently operate at our margin levels despite having already achieved Rule of 40 status. At the segment level, we are increasing our expectations for Merchant Solutions adjusted net revenue growth to be around 20% from high teens previously, which assumes the current pace of recovery continues worldwide. This marks the second consecutive quarter that we have raised our outlook for our merchant business. We are also increasing our outlook for our issuer business and now expect growth to be in the low to mid-single digit range for 2021, up from our prior outlook for low single digit growth. We continue to expect our Business and Consumer segment to achieve mid to high single digit growth for the full year, consistent with our long-term growth target for net spend. As a reminder, we increased our guidance for this segment on our first quarter earnings call in May, despite lapping the impact of the 2020 CARES Act. Moving to non-operating items, we continue to expect net interest expense to be slightly lower in 2021 relative to 2020, while we anticipate our adjusted tax rate will be relatively consistent with last year. Putting it all together, we are increasing our expected adjusted earnings per share for the full year to a range of $8.07 to $8.20, reflecting growth of 26 to 28% over 2020. Our raised outlook presumes we remain on a path to recovery worldwide over the balance of the year. We look forward to updating you on our longer-term expectations for the business at our upcoming virtual investor conference, which we will host on Wednesday, September 8th. And with that, I'll turn the call back over to Jeff.
Thanks, Paul. As we look ahead to next month, it is worth reflecting on how much we've evolved our business. Throughout much of the last 8 years, we have witnessed a multitude of new market entrants, newly public companies, shifting modes of competition, and macroeconomic cycles too numerous to count. Some said a number of times over the near last decade that our best days were behind us. The facts say quite the opposite. In fact, we have delivered the greatest value creation in our history during that period, and we believe we are poised today to continue our track record of outperformance. The second quarter and our raised guidance today are the most recent examples. Our rates of revenue growth and bookings trends underscore sustained share gains despite managing through an unprecedented crisis. One proof point, we now expect our U.S. payments business to roughly reach its original growth target for 2021 based on 2019 goals. In short, we grew right through the pandemic. More to follow in September. The reasons for our success are straightforward. Our distinctive strategies, the technology investments we have made over many years, the support of our market-leading partners and customers, our execution consistency, and the quality of our team members have allowed us to significantly expand our competitive moat. As painful as it has been, COVID-19 has reaffirmed the wisdom of our long-held beliefs in the digitization of our businesses. We believe that the best is yet to come. You can judge that for yourselves next month. Winnie?
Before we begin our question and answer session, I'd like to ask everyone to limit their questions to one with one follow-up to accommodate everyone in the queue. Thank you. Operator, we will now go to questions.
If you would like to ask a question, please press star, then the number 1 on your telephone keypad. Again, that is star, then the number 1. And your first question is from Vasu Govil with KBW.
Hi, thanks for taking my question. Great results here in the merchant segment particularly, but actually across the board. So maybe to start off, just looking at the merchant segment, revenues relative to 2019, I think they're roughly 12% higher. Could you talk about what's driving that? Are you seeing a lot of pent-up demand among consumers that's driving that type of growth? And just trying to gauge whether as we go forward, this type of growth rate could accelerate going forward if there's a lot of pent-up demand.
Hey, good morning, Vasu. Thanks for the comments. It's Cameron. I'll kick it off and maybe ask Paul to provide a little bit of color as well. So I would say it's a few things, and I would start with just the efficacy of our strategy. Obviously, the technology-enabled businesses that we've been investing in for the last 7, 8+ years now really continue to lead the way for growth across the business, including our integrated business, which grew 53% in the quarter and up 35% versus 2019 levels. In addition, our e-com and omni business grew well over 20% this quarter, again, topping performance from last year where it also grew in the high teens level. So again, relative to 2019, continuing to see very strong growth across the e-com and omni channels of the business. So for me, it's really the strategy that we've been deploying that's driving growth, and I think we continue to see a lot of tailwinds in those businesses looking forward, through the balance of 2021 and heading into 2022 and beyond. Paul, I don't know if you want to add any more specific comments on that.
Yeah, I would just say, as we said in the press release, we're pleased so far with what we've seen in July as well, as it relates to kind of continuing improvement relative to 2019, really across the merchant segment. And the only other thing would be, we were pleased to see the growth in the vertical markets when you're talking about just a segment, the 30% improvement year over year in the vertical markets business. So yeah, I think that covers it.
Got it. And just for my follow-up, I wanted to ask a capital allocation question. I saw that you guys raised the share buybacks. Any color on, whether you're expecting to do more buybacks versus M&A? And on the M&A front, I know historically you've been focused on doing accretive deals, but given where valuation for fintechs are, that seems to be becoming harder and harder. So Just curious on your thoughts, would you be open to doing something that's revenue growth accretive, but perhaps earnings dilutive at this point, if it makes sense for the long term? And if yes, like what are some of the areas that such a deal might make sense for you to do?
Yeah, so this is Paul, and I'll cover the share repurchase and then maybe turn over to Jeff on the M&A side. Yes, we did resize the share repurchase authorization due to the fact that we had made significant purchases since our last authorization. And, we've said all along, our preference is to allocate capital to M&A. When an M&A opportunity is not in front of us, we will deploy capital on share repurchase, and we were very pleased to do so this quarter, much like we did last quarter. So, we do not have share repurchases in the guide as a go-forward matter for the back half of the year. But, we are always opportunistic as it relates to, share repurchase. And so we want to make sure we have the capacity to execute if we choose to do that. Jeff, you want to talk about the M&A side?
Yeah, thanks, Paul. So Vasu, on the second part of your second question. So we actually have been very active on the M&A front in the last 6 months. I think with today's announcements with Bankia, we've committed about $1.3 billion, U.S. to M&A in the last 6 months, while committing to about $1.5 billion on the buyback. So as we said in the press release, I think we've been very balanced between the two. As we also said in the last quarter, Zego is a technology and software-driven business, very consistent with our strategy, particularly given the size of the real estate target addressable market. Yet notwithstanding that, going back to the premise of your question, that deal was not dilutive, and I think we announced it was immediately accretive, although really no discernible impact on earnings, but nonetheless was not dilutive. We look at many things, so it's hard to say what we would or wouldn't do, in the abstract. What I would say is, since we've been running the company in the last 8 years, we've not done a dilutive deal. I don't expect us to. That's not the mindset we have as shareholders and owners and managers of the business. So I really don't expect our strategy to change.
Got it. Thank you very much for the color.
Thank you.
Your next question is from Ashwin Shirvaikar with Citi.
Hey, Jeff, Cameron, Paul, congratulations on the good results. I was kind of hoping, coming out of the pandemic, or at least sort of, lapping pandemic impact, if you can kind of provide a breakdown of the expectations, tech-enabled businesses, 3Q versus 4Q. What do you see? What part of the recovery is volume sensitive that's yet to come that benefits forward numbers, education, events, things like that? Some quantification would be great on 3Q versus 4Q.
Yeah, Ashwin, I'll start off, and maybe, Cameron might want to add something as it relates to merchant. But, largely speaking, we're expecting roughly 3Q and 4Q to be largely similar across our businesses. As we had said at the beginning of the year, we had expected the back half of the year to, return to a much more normal kind of state. And so clearly there's some reopenings that will continue to benefit kind of 3Q into 4Q as countries around the world kind of reopen from some of the closures. You're exactly right, Ashwin, as it relates to some of our vertical markets businesses. As I just commented, we're very pleased with the growth we saw in 2Q, but we would see more meaningful growth on those businesses in the back half of the year as we have, more reopening and kind of more tailwind kind of impacts as it relates to those businesses. So, yeah, those would be the dynamics between kind of Q2, Q3 to Q4, certainly in merchant, and there wouldn't be anything I would necessarily call out across the other two businesses. Obviously, very pleased to raise the revenue guide on our issuer business from low single digits to low to mid single digits. So it talks about kind of improving fundamentals in the back half of the year there, and pretty static state as it relates to our business and consumer once kind of the stimulus impact has been netted out of the first half and going into the back half. Cameron, do you have anything to add?
No, I think that covers it pretty well, Ashwin. I would only add just a couple of points. One is across the technology-enabled businesses, as I mentioned previously, going to the first part of your question, we're continuing to see very strong momentum in those businesses. As Paul highlighted, July sequentially is better than June. as a trend matter. So I think we feel good about how things are continuing to progress, and those businesses are poised to continue to see strength in the back half of the year. If you just look at the overall guide from the merchant segment, that roughly 20% growth, in 2021 versus 2020, the back couple of quarters kind of have to be around that same level to make the averages work for the whole year. So that gives you a sense as to how the business is performing, again, against tougher comps in Q3 and Q4 than we certainly faced in the second quarter. So I think that should give you a little bit of a sense as to the momentum that we have in those businesses. To Paul's point around the vertical market businesses in particular, obviously schools, once we get back into obviously a normal school environment, or hopefully quasi-normal school environment, here in August and September, that business is in particular is poised to see a rebound in the back half of the year, as well as active. Active